Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 118th episode. We're recording this podcast on the 5th of March, the week of China's National People's Congress, or NPC. This is a critical year for China's leadership. It's the 75th anniversary of the People's Republic, and the nation is, of course, facing multiple geopolitical, demographic, and economic challenges. Real estate crisis, deflationary pressure, flagging investor confidence, it's all there. And additionally, China's exporters are facing numerous existing and forthcoming restrictions to trade from the US and EU. So what to make of the NPC in the middle of all these headwinds? What lies ahead? Bert Hofman, adjunct professor at the East Asian Institute at National University of Singapore, is here to talk about all this and more. Bert is also a senior fellow at the Asia Society Policy Institute. He has spent most of his career at the World Bank, including a long stint as the country director for China. This is Bert's fourth appearance on our podcast, and that's a first for any guest. Bert Hofman, welcome back to Kopi Time.
Oh, great to be back.
And busy day for you, I'm sure. You must have been following the speeches and giving your views to your followers in the Twitterverse. But now we have you, Bert. The two sessions of this week at the Great Hall of the People, big formal affair, but also fairly consequential for the rest of the year. You've seen the projections and policy announcements, Bert. What do you make of them?
Well, look, the 5% or around 5% growth rate that's probably the headline. That is a bit higher than most of the market would see it. I'm not saying expect, but the way they projected, the IMF projected 4.6% for the coming year. Around 5 is a bit higher, and it means that the government would probably have to provide some stimulus to the economy. That's not altogether clear yet from the numbers. The headline fiscal deficit was the same as last year, but the headline fiscal deficit of 3% doesn't really say that much. Unfortunately, the presentation of the budget, the way China does it, means that you really have to read in between the lines to see whether there is a fiscal stimulus or not. It's not trivial to stage a fiscal stimulus because in the past, government always used local governments to deliver that stimulus. This year, they've announced that the local governments are allowed to borrow 3.9 trillion RMB, which is 0.1 trillion higher than last year. So that's sort of a positive sign. But at the same time, a lot of local governments are not inclined to borrow because they actually have a debt problem. So it really remains to be seen whether that is really the tool with which the government can deliver that stimulus. You mentioned deflation. Well, the CPI number that Li Chang presented this morning was 0.2% over last year. The projected level is 3%. Now, that is really quite ambitious. So it would actually imply that a lot more stimulus would have to take place. The key reason for that is that the government is pivoting towards what they call high quality growth. And with that, they try to move away from this more credit-based, stimulus-based, real estate-based growth of the past 10 years, if you want, ever since the global financial crisis, towards more innovation-driven, more productivity-driven growth. That's all good and well. And as a matter of fact, they're actually doing it quite well. If you look at sort of the resource reallocation, the credit reallocation towards manufacturing is going very much in the right direction. The problem is that a lot more supply comes on stream from that manufacturing, whereas demand is still lackluster. Yes, consumption demand didn't do so badly last year. As a matter of fact, it was leading growth. But that was more the rebound of the COVID lockdowns that we saw in 22. So that looks pretty okay. But overall, the underlying trend in consumption is not yet strong enough, which means that external surpluses overall, but especially in manufacturing, are quite large. And that by itself complicates China's external situation, i.e. the Europeans and the US now are balking against this sort of big supply coming from China, particularly in areas such as electric vehicles and other renewables, where China is a big supplier for the whole of the world. So that will cause some tensions down the road. So in other words, even the 5% is going to be a bit of a challenge to get there.
And what's your sense of, the sectoral approaches? So you just mentioned EVs, so there was quite a bit of language around productivity, innovation, and research and development, and so on. This good quality growth. Of course, we all want good quality growth, and I'm sure, Bert, in your career as a World Bank country director, you talked a lot about moving away from investment-driven to consumption-driven growth model, and your colleagues across 19th Street and the IMF did the same. Now, I want to sort of touch upon one conundrum, which is, we're talking about a country that has grown very fast, and in the past has delivered excellent returns to investors. Today, it accounts for 18% of the global economy. A third of global growth still comes from China, but the financial markets keep selling off. While you're seeing in the US, the financial markets are hitting record after record. So what should we make about this divergence, Bert?
Well, look, first, the world outside has changed, and there's been a major adjustment of monetary policies in Europe and the United States. So suddenly, the 4 to 5% that you can make in China is no longer good enough. That used to be really good when interest rates were zero, basically, in the United States and Europe. Now you can get a risk-free 4.5% in the US, similar in Europe, on treasuries or European government bonds. And so that's different. That explains a lot of the portfolio outflow that came from China. Second, foreign direct investment into China didn't do so well. That's in part because of the complications of COVID, hard to assess the geopolitics in all of this. So I think a lot of foreign investors say, well, if I'm there, I'm reinvesting my profits. But if I'm not there, I don't know whether I want to be there. And some that are there, they say, well, maybe we should look at the China plus one strategy. And that is starting to emerge. So that's the second area. The third, that's really China domestic regulatory, and moving towards quality growth is fine, as you say. But investors would say, am I still going to make money out of that? And that's less clear. And mind you, the objective of high quality growth, of higher quality growth, has been around for a very long time. But I think it's fair to say that the way China wants to achieve it has changed. Whereas before, and I'm talking 2013, where China published a major decision document from the third plenum of the 18th Party Congress. Forgive me my long title. And that basically said, we need to move to high quality growth, more innovation driven growth, more productivity driven growth by means of the market, and making the market the decisive force in allocating resources. That was the third plenum of the 18th Party Congress. Since then, the government, under the leadership of Xi Jinping, has taken a different direction. And now they're basically saying, yes, we should deliver that high-quality growth with the state in the lead. I'm not saying we're neglecting the market as a tool, but as a tool to deliver on the state's objectives. And that's quite a different approach. And I think a lot of investors say, well, am I going to make money out of that? And that's in the end what drives investors. I think for some, the answer is, well, maybe not. And that in part explains sort of the downward pressure on the stock market. Stock market in China, I think, has never been a good indicator. I joined the World Bank's China team 2 years after the first stock market was opened, and I just couldn't understand it. And I'm still not sure whether I understand the dynamics that drives the Chinese stock market. There's an addition on the retail side of investment. There, it has never been as important. 2/3 of Chinese households' wealth is in their housing. But they also see this volatility in the market, and it's one thing that they don't like. Now that they've come they've gotten the message from the real estate sector that actually their apartments is not necessarily going to deliver on their pension down the road. And they become more conservative, I think, in investing. You see deposits, household deposits going up quite strongly. And I think that's a reallocation from, on the one side, real estate, from the other side, from stock market investment. So whether that will turn around depends a lot on whether households and domestic investors are regaining their confidence in the growth of the economy.
So, Bert, if you can't make any money in the stock market and you can make money in the property sector, and interest rates are going down where the rest of the world is going up, we should be seeing a massive, flight to, away from RMB denominated assets. Are the Chinese capital controls that effective that the Chinese have no way to take the money out? Or are there some materially different, dynamics at play now than they were a decade ago? Because we did see big outflow pressure on the RMB during the taper tantrum episode a decade ago, and PBOC lost a lot of reserves trying to intervene. How come we're not seeing that this time?
Well, I think you see some of it in the balance of payment. And if you look at the numbers, if you look at the increases in the net errors and omissions, you might see some of it. If you look at some of the trade data, don't quite match with what you sort of see on the counterpart side. So there's probably some capital flight ongoing. But from the 2015, 2016 events, I think China has learned and they've tightened up the already existing regulations quite a bit. So yes, it is in a way harder to get money out of China beyond the legal limit. And the legal limit is not that high. It's I forgot what it was exactly. I think it's $50,000, not small money, but $50,000 per person that you can take out. That process to get it out, I hear, has also become quite cumbersome. So to some extent, it is a managed capital account for sure. Those foreign investors that came in through the legal channels, the qualified foreign investor channel, they have no problems in taking it out. And that's also what you see actually in the last year and a half, the outflow of portfolio investment into China.
Right. But at the same time, the government will issue quite a bit of bonds. In addition to the local government issuance that you talked about, we saw some announcement about ultra long tenor bond issuances. Surely it wouldn't be a problem for the government to finance its deficit, right?
It won't. It won't. There's enough savings around, and the way that finances the banks with their increased deposits, they can very easily buy government bonds on the market, and that's the main mechanism for China. So,
yeah, that's what I sort of surmise as well. Bert, I want to talk a little bit about the confidence issue. You just mentioned that the local domestic confidence is poor. You talked about this in an article you wrote last year for Asia Society. You stated China's economic plight can better be described as an expectations recession. Lasting growth would require deeper reforms to change expectations held by households and private sector. So let's talk about that. How would the government change the expectations, which is pretty much at its floor right now?
Well, look, I think the government has done most of what it can do in terms of talking. There was a bit of a shock, and there was a realization that confidence is a real factor. As a matter of fact, it shows up in government documents. It showed up again today, the government work report. And I think the government has done a lot of communication. They met with the private sector. They continue to emphasize the private sector is very important. I think now the proof of the pudding is, so what's actually going to happen? What in concrete measures is happening that we can see there is room for the private sector, and that has to do with individual licensing decisions to see whether private sector actually can have access to all these funds that are supposed to stimulate research and development and innovation and otherwise, and whether there is again an opening for private entrepreneurs to make use of. There's still quite substantial growth that we're going to see from China. The 4 to 5% is not small growth. You can make money there. So I think it is really the proof of the pudding now, and that will gradually then rebuild rebuild some of the confidence. The other factor, though, and I think that is important, and that is still yet to be seen, is how much is this high quality growth, and that drives expectations quite a bit. I mean, China is used to a tradition of the government saying, okay, well, this is going to be the growth rate, then we're going to make it no matter what. Nowadays, with high quality growth, that emphasis is a bit gone. And if you're used to targeting your investments and your spending decisions based on what the government more or less says is going to be the growth rate, then suddenly you're thrown into uncertainty if that's no longer the binding constraint, if it's no longer the critical key performance indicator for government. So I think at some point it should be clarified sort of, well, what can we expect of this high quality growth? And what does it actually mean? Because high quality growth is great. I think that the supply side is pretty much defined. But to go with that, the distribution of that high quality growth is unclear. It's an objective, but it's unclear. The environmental measures that go along with it, important, but quite unclear how that is going to hit the various industries. So the changing goal itself has brought about a number of uncertainties that would need to be removed. Over time. I think that's important. For households, frankly, the key is the real estate market. There is this fear, it's not yet reality, but this fear that prices might decline very, very sharply. And what would then happen to me as a household? That is a task for the government in this case. There's no other actor to ensure that indeed the measures are taken to stabilize the real estate market. It's not going to be like before, and frankly, that's not desirable. But the government has put in place a number of plans that I find reasonable, especially in social housing, in rental housing, that can still maintain a relatively a downsized but robust housing sector and construction that would then lead to a stabilization of prices, say, and that would give comfort to the household sector. The second part, and that's still a conundrum, and I'm not quite clear where the government's going there. With the high quality growth, with the move to the renewed emphasis on manufacturing for the households, the question is, so where's the jobs are going to come from? And I was just looking at some statistics and government statistics on employment. The automobile sector is booming. It's doing great. It's got 4.5 million people unemployed in that sector. That's the same number as in 2015. Mm-hmm. So in other words, and if you look at a modern car factory, all you see is robots. So the automation and the capital intensity of those sectors that are currently being promoted by the government, that does not result into sufficient jobs for those people that just come from university. There's another 12 million coming from university this year, Li Qiang just said, and they've been trained in all kinds of things, including in past generations in skills that may no longer be that much desired. But nobody will go into a factory of the people that have done computer science or something that they thought they were going to be coders for Weixin, or for WeChat, and suddenly they need to find different kinds of jobs. So that is adjustment, and the related issue of youth unemployment, I think also weighs quite heavily on households and households' expectations. It's not, I mean, people find jobs, but everybody knows somebody who didn't find a job, and so there's sort of this almost sort of this through social media, sort of the people get this impression that actually the job market's not doing well, and that lingers on expectations. So one of the, I think the government will come to the realization that, look, the big job creator, whether you like it or not, is actually services.
Absolutely.
It's the services sector, and it's been for the past 15 years like that. For any country that goes above China's per capita income, you'll find the services sector being the big job generator. And so creating sufficient space for that, not overly being too heavy-handed with regulation of that sector so that the sector can thrive, I think will be the key for creating more employment.
Okay, that is absolutely key. I mean, if you had not mentioned it, I was going to jump on it at that point exactly. So, are we talking about a flaw in the existing growth model, which is in the name of good quality growth, we may be actually looking at sort of making the service sector a bit subservient to the manufacturing sector, but from a job creation perspective, that's not a good thing. Is there recognition in the Chinese policy circle about that issue?
Not that I know of, but it doesn't nowadays. That doesn't mean that much anymore because it's a lot of the policy discussions is now behind closed doors. It's hard to see what is going on. That by itself is not a great signal. It would be great if there were a debate in the open on whether the new growth model meets all the goals of Chinese society. That by itself would be helpful. I believe that economics basically says that in the end, the government will come to the conclusion that they need to be more active in promoting the service sector, or at least not just saying things about the manufacturing sector, because that's important for entrepreneurs to say, oh, actually, I can find my way into the service sector. It may not be the focus of the government, but I can make my business there. I can make my profits there. So that, and again, it's this big shift that has been going on from a development model which was not sustainable, and everybody agreed on that, to something new that still needs to fill out some of the blanks.
Right. So, Bert, when you wrote that Asia Society article and talked about this expectations of recession, you were sort of countering some of the things that Richard Koo has written in terms of balance sheet recession. So, those who don't know, Richard Koo in the past have written a lot on Japan's economic plight and had a rather compelling look at Japan's problems through the balance sheet approach. You don't think that you can necessarily look at the same Japanese lens and project that onto China?
Correct. I mean, I appreciate Richard's analysis of Japan, brilliant analysis, and the one that really brought it down to something that indeed makes sense. China is still quite different. First, the magnitudes of decline are not in the order of magnitude that Japan saw. And I in that piece, I quote a former governor of Japan's central bank. And the numbers were stunning, that the decline in wealth, balance sheet wealth, between 1990 and 1998 was 245% of GDP. China's nowhere near there. Yes, there is price decline, and the real price decline on real estate is probably higher than what is monitored through the official channels, but nevertheless, it is not in that order of magnitude. Second, the big problem in Japan was that it was not just, if you want, those engaged in the real estate bubble, etc., but it was everybody, because everybody was engaged. So it was the households and it was the businesses that were engaged heavily into basically beefing up their balance sheet with inflated, with bubble-style asset prices. And so when the deflation hit, it hit everybody, and the only one that could step in was the government. In China, the balance sheet problem is really quite restricted still to the real estate sector. And yes, the Evergrandes of the world are in real trouble, and some have been told to close down by Hong Kong courts. So those are real issues, no question about it. But beyond that, it's not big enough yet to affect the banks. It's not big enough. It is not that much spillover to the rest of the economy, the rest of the businesses. And households, as I said, unless there's a major downturn in real estate prices, are still not that much affected. There is a lot of uncertainty, as we discussed, but it's not that you can say, yes, we take the balance sheet and, there's a very big hole that needs to be filled. So I would hesitate to call a balance sheet recession now. It doesn't mean that over time it wouldn't turn into one if nothing were to happen. But I don't project that, frankly. There's some other more detailed issues on demographics, but we can maybe discuss that sometimes some other time.
Right. One big thing in the case of Japan that sort of became a source of paralysis was the cross-shareholding of Japanese financial sector. The banks owned property companies, they owned shares in other banks, and as a result, everybody became sort of reluctant to recognize losses on debt because that would have had an impact on their equity value and so on. I have tried to analyze this issue in the context of China, and I've looked at a couple of GFSR reports from the IMF where they've tried to take a dive into this. I think the first impression is that we don't have very good data, but even in the presence of somewhat not good data, it doesn't seem like it's that prevalent in China, the cross-shareholding issue. What's your impression?
No, I would agree with that. I haven't seen the analysis, love to see it, but I would agree with that. And even so, the trust in the banking system remains quite high, and therefore they may have issues in non-performing loans. And if you really look at the banking system, the non-performing loans are quite a bit higher than the items just tagged as non-performing loans, because there's a lot of investments on the banking balance sheet that are really loans that are not performing, but that might at some point perform again, or debt equity swaps, etc. So those become investments if the intention is to hold it until maturity. But even with the banks, given the basically ironclad guarantee from the government on the banking system, and in addition, the difficulty of taking out your money anywhere else, frankly, it's very hard to sort of see an implosion of balance sheet happening in China as it did in Japan.
Right. I want to talk a little later about the impact of debt and deflation. But before that, one area which is I'm kind of was hoping that there'll be more discussed in the two sessions. Maybe it's just a given now or reality in China that you don't have to mention separately, which is green investment. So I read this fascinating analysis by the Center for Research on Energy and Clean Air, and they had this report where they estimated $1.6 trillion worth of contribution from clean energy on China's economy last year, which they estimated accounted for all the growth investment and a larger share of growth than any other sector in China. And the report also said something like China invested $890 billion in clean energy investment, a 40% year-on-year increase, as almost as large in total global investment in fossil fuels. So, Bert, I think I told you a couple of years ago that at a podcast I did with our friend Jun Ma, he had said that China should spend or would spend 4 to 5, even 6% of GDP a year on green to get its goal of 2050 net zero done. It seems like they're beginning to deliver. What are your views?
Well, they're delivering of sorts. They're still well short of what they could do, and that is the one option that I see for China. And this conundrum of we don't want to have this infrastructure, real estate-driven growth, but we want to move to manufacturing, which provides insufficient demand. The total, and it's an estimate, but the total investment needed to meet Xi Jinping's net zero by 2060 is about 100% of 2020 GDP. So that's 2.5 percentage points every year. They're sort of at that level in terms of green investment. But you could also say, well, in the first decade, we double that or we triple that, because right now we need demand. So I find that an opportunity that can be used to sort of substitute a good stimulus, if you want. A good stimulus lies at the green stimulus is there for the taking. That's not everything will go right, but it's by and large good investment that are going to be productive in a greener, cleaner, less carbon intensive world. And the government could say, okay, we're going to accelerate that. And that would be a very good investment. It would be a good stimulus. And it's pretty similar, the type of input that you need in the green investments are not that dissimilar to the inputs that you need into normal infrastructure or in housing. So it would also, from an employment point of view, from a construction sector point of view, it would actually add up. And I believe that that's something that the government can definitely explore.
Right, and they import so much fossil fuel. I mean, you would think that even from the newfound, global zeitgeist of security, energy security and food security and so on, it also makes sense from a strategic perspective. Bert, I am going to read you a longish section from a Wall Street Journal article, which may have an agenda. So I want you to sort of tell me if you are seeing an agenda in what I'm about to read, or just in general, your view on this issue. So here I go. China's factories are churning out more cars, machinery, and consumer electronics than its domestic economy can absorb. Propped up by cheap state-directed loans, Chinese companies are flooding foreign markets with products they can't sell at home. Some economists see this China shock pushing inflation down even more than the first inflation shock they're talking about 20 years ago. China's economy is now slowing, whereas in the previous era it was booming. As a result, the disinflationary effect of cheap Chinese manufactured goods cannot be offset by Chinese demand for iron ore, coal, and other commodities. So I suppose the basic point in this article is that we're in for a second deflationary shock from China. What do you think?
Well, first, I think you can substitute China with Germany. China's bigger, but I don't disagree with the data underlying this analysis. I don't think the tone is very fair. Because if Germany has 6-7% of GDP surplus on the current account, they say, "Oh, Germany is very competitive." If China has to say, "Oh, it's terrible, lack of domestic demand." So I think this is sort of an asymmetric treatment of that. Second, what I said before is indeed the lack of domestic demand will mean that prices domestically are actually falling. And GDP deflator over the past year was 0.6%. The last quarter, it was 1.6%. The producer price index is also much negative. So Chinese companies have a hard time domestically, and prices go down. In part, that is also on the international market. Not just by Chinese companies, by the way. I mean, you also see most of the car export of China, which has attracted headlines around the world, they are still with internal combustion engines. And that's Chinese companies, but it's also other companies. Part of the electric vehicle exports is Tesla, not BYD. Yes, it's BYD, but it's also Tesla. So I think you need to disentangle that a little bit. But the punchline for me is that, well, weren't we fighting inflation everywhere else around the world? So wouldn't it be helpful if China were to offer consumer goods that people want at a lower price? Isn't that a good thing? So I'm a little bit with the implication. I don't disagree with the analysis, and I've done the analysis myself. As a matter of fact, what I tell my Chinese colleagues is something related but different, and others have made this analysis as well. But if you look at China's surpluses in manufacturing, that's growing, and it's nothing out of the ordinary if you look at it in terms of China's GDP. But if you look at the surplus in terms of world GDP, it's twice the level that it was before the global financial crisis. And everybody was complaining then. So what I see coming is a lot of resentment there. And you hear the noise from the Europeans already that oh, actually, this is China. Through inappropriate policies, they can export so much. The key argument always being, oh, well, they have all these companies have access to cheap loans. Well, yeah, the US and Europe just had a decade of zero interest rates, so I don't quite know where that complaint is coming from. But there's some concerns also with subsidies and others that could have been subject to a WTO process. Unfortunately, that's no longer possible. Yes, Europe is doing its investigation into subsidies, but it will in the end be a one-sided action by Europe because there's no more appellate body in the WTO, so therefore there's no final determination of who is right and who is wrong in this. But more broadly, I think this is risky territory for China. Its model of sort of for the future may not work if there is a very strong reliance on external demand in those new sectors. So, ergo, the conclusion is they must work on that domestic demand.
But at the same time, Bert, you could say that, okay, America with its rich customers and Europe with its rich customers may pursue tariffs and whatever to keep Chinese exports out. But I've seen that Latin Americans, Africans, most of South Asia, Middle East, Southeast Asia, I don't think they'll be averse to the reasonably priced or cheaply priced Chinese products.
But you hear the same noise from a Brazil, from a South Africa. So we're getting flooded by Chinese goods, and so it's broader than just Europe, and it's broader than just a rich country fad, and I think it is to some extent, it is a bit China's issue, even if the allegation may not be correct, but the lack of domestic demand is an issue from China's point of view, and from an employment point of view, from a growth point of view, but it's also an international issue.
Right. I want to talk to you about China and Trump, if there is going to be a Trump 2.0. But before that, independent of who is the president of the United States in early 2025, the movement toward tech-related restrictions over China. For the longest time, it was that there has to be a gap between manufacturing capabilities in China versus the West. But it seems like we're going much further than that. And one is that the gap needs to be widened. Nobody really knows how much wider. Should China be 3 generations behind or 4? I think the Americans haven't made up their mind on that. But it seems to be even deeper than that, which is that we will not actually let the Chinese procure even the products. So not that they can make, they cannot even procure them. So I'm seeing various companies that are trying to get licenses to export somewhat lower powered AI chips. They're now finding themselves under review by US authorities that they can't even export that. So where do you think this tech war is going?
Well, a couple of years back, I wrote an article which was called Trade, Tech, and Trust. And I think a lot of the more extreme views, because, the United States is a complex place, there's lots of views. There is the Trump thing, but there is, even within the administration, lots of views. You now represented more, if you want, the Jake Sullivan kind of, the national security-based view. And Sullivan has been very clear. He came out with a speech, it's now more than a year back, but where he said we need to keep China behind, i.e., not relatively, but absolutely. That was later softened by Yellen, and it became much more sort of the European approach. And as in fact, the G7 agreed on the de-risking approach. So a narrow national security, the small yards with high fences type of approach. The problem with that is that and even assuming that is feasible, the problem with that is that on the Chinese side, they would say, well, yeah, so today is the below 10 nanometer chips, but what is it going to be tomorrow? So as soon as you invoke national security in some of these tech measures, you don't know where this is going to end. Is it from a Chinese side? So from a Chinese point of view, from a national security point of view, you say, okay, so we have to rely on our indigenous innovation. And then once you start thinking about national security, then suddenly, as Mr. Biden thinks, suddenly an electric car is also a national security risk. So that conversation is not very productive. And but at the same time, it's a topic where a WTO can discuss things, but also there's other mechanisms. Believe it or not, well, I'm old enough to know in the old Cold War, there was the COCOM list and all the stuff that you couldn't sell to Russia. And that was a pretty elaborate list and pretty effective as well. Only the East Germans could sort of take apart the West German high tech and then send some of it to Russia. The successor to that was the Wassenaar list. Now, interestingly enough, this Russian Federation was a member of the Wassenaar group to determine the list. It was a platform for discussion. And I think it's very important at this point in time to create that platform. Is that the WTO could play a role, but it could also be elsewhere. And it doesn't have to be everybody at the table, but to sort of start that conversation. What is a reasonable assessment of security risk, and how can we stop that? I think some in the US and even in Europe, they say, look, national security goes beyond particular technologies. It is simply, we need a strong economy. We need steel, we need boats, so the whole of the industry is affected by national security. That is hard to deal with because that would lead to a fairly far-reaching decoupling, which, as you know, would also lead to large efficiency losses and, frankly, a much less prosperous future for the whole of the world than it could be if this issue of national security is managed well.
Yeah, not particularly, hopeful in those areas. But talking about things that are not particularly hopeful, then polls in the U.S. are suggesting a pretty decent chance that we'll have Donald Trump come back to power. When people ask me, what will the world look like under Trump, I said, there's very little surprise there. We know exactly what he'll do because he said it. The significant ramping up of tariffs against China, perhaps even a generalized tariff against all imports, and a whole bunch of things that will happen on the geopolitical side that we don't need to talk about here. But from China's perspective, should a Trump 2.0 be a rather disastrous one?
So, well, first, I think, Trump's age is a real problem. So I think we shouldn't, no, that's a joke. I think from the Chinese point of view, they actually fear Biden more, I believe, than Trump. Part of the reason is that Trump was as detrimental to the allies and partners of the United States as he was to China. The first tariffs that he announced was on aluminum from Canada, its closest partner, its absolute closest partner. So Trump seems to be much more like an America first rather than anything else. That is great for undermining the strongest asset that the US has, namely partners and allies all around the world. If you look at China, China has lots of good relationships, but they have one treaty ally and maybe one close partner in Russia. So this is one of the key strengths of the United States that would be undermined by Trump. And it would mean that a lot more countries would start leaning towards China economically, but even from a security point of view, because the second part where Trump has been very explicit, he no longer wants to pay for the defense of other countries. That is a misguided thought in terms of what is actually happening and what are actually mechanisms like NATO doing. But irrespective, that's the way candidate Trump thinks. And it may mean that indeed the Europeans would have to rely a lot more on their own defenses. That dynamics can again be very detrimental, because if you have to rely on your own defenses, you have to rely on your own defense industry, because you can no longer rely on potentially getting all your weaponry that you need from the US, even aside from not having the might of the US behind you. So that dynamics is really a bit depressing, and I'm not sure whether, thinking through all the consequences, whether everybody in the U.S. administration and the future administration would agree. So I think for China, it's a plus or minus. I mean, they've been building down the exposure to U.S. in terms of exports already quite dramatically. They have found channels around the Trump version 1 tariffs through Mexico, through Vietnam, through India even, where China is increasingly export semi-finished goods to those countries, and then they become other countries' goods. I'm not saying that that is sustainable, but it's something more manageable for China. I think one of the key misconceptions in the thinking of Trump is that China is still a very export-dependent country. And yes, they're still doing well with exports, and they need exports for demand. But there's other sources of demand, and the biggest growth in exports is, of course, not the United States, which is by now quite negative. To Europe, it's more or less flat, but it is ASEAN, it is all the Belt and Road countries where you see their share in China's exports is skyrocketing. And the share, if you want, of the old powers, the G7 and Europe, it's declining, but now it's below 40%. It used to be almost 60%. So that is really turning around. And I don't think, so in other words, for China, it's a little bit pluses and minuses, but what Biden has done, I believe, is quite effectively mobilizing its partners and allies in the Asia-Pacific region for any eventuality that might happen. Even the Philippines came back into the fold, if you want, offered the United States space for bases, and that's good diplomacy. And Chinese don't like that because they think that this is a containment policy. But so therefore, maybe they in the end think they can benefit more from the roughness of a Trump, because Trump would destroy a lot of alliances of the United States.
I hear your point. When I look at China's trade surplus vis-a-vis Vietnam or Mexico, they've gone up a lot, meaning that there are a lot of companies in there with Chinese capital or taking Chinese inputs, which are exporting into the U.S., circumventing some of these tariff walls. I do worry about the generalized 10% tariff, because I think that'll be a bit of a trade shock for the whole world. And at a time when we still have some inflation worries. Earlier, I talked to you about deflation. I think then we'd have to worry about inflation shocks if we are going to have some generalized tariffs. Bert, before I let you go, final thought on industrial policy, which is very much in vogue in Europe and the U.S. now, particularly in the U.S. under the Inflation Reduction Act. Do you think China is doing good industrial policy these days? I mean, would you say that the whole EV outcome is a successful, manifestation of industrial policy?
I think China is doing it better than before, and they are used to it. Whereas if I look at the industrial policies as announced by Europe and the United States, it may not be what it takes. China has a problem that they do too much of it. And I had this one, I need to paraphrase the quote, and I also make it a bit more Chinese, but somebody said, look, China's industrial policy is like throwing a big bowl of noodles at the wall and then invest in those areas where the noodles stick. The problem with that is that China has an awful lot of noodles. Now, it was actually with spaghetti, but I make noodles because it is China after all. Now, that's, I think, is China's problem. And if you look at the new setup, China's really making a whole of society effort into many areas of industrial policy. And that is, I don't think that's very productive for China in the end. They have better coordination now than, say, 5 or 10 years ago when it was all over the place. But it increases the defenses from other countries, because they say, well, you see, we're telling that China never obeyed by WTO rules, and look, it's becoming less and less of a market economy. I'm not saying that's a fair argument, but that's the argument that's going to be made. The more industrial policy China has, and the more effective they will be, the more you will hear that argument. So I think China should do a little less. Europe and the United States should think about it a bit more on how would they exactly do this. Europe is very clear. Europe Well, the best thing that they can do is break down the remaining barriers between EU countries. It's the biggest obstacle. The second biggest obstacle is the financing, but it's related. Like if you invent something great in the United States, you have the United States. If you invent something great in the Netherlands, you have the Netherlands. So you and then you have to struggle through the regulatory mechanism in order to finally make it a European. So there's still a lot of barriers, formal and informal, that prevent Europe from being a very big player in new industries, simply because they can't scale up rapidly enough compared to the United States. And China is increasingly there. They're not there yet. There's lots of divisions between provinces, between municipalities. There's lots of subnational industrial policies that distort the market quite a bit, very much recognized by the government as an issue. But to unify that market would, in my view, be the most powerful industrial policy tool that China can do for itself, just like Europe.
Yeah, that subject remains a live one. So maybe when you come back for the fifth time, we'll devote more time to that issue.
Well, at the end of the year at EAI, the new director, Alfred Schipke, he has announced that we would do a conference on industrial policy with participation from Asia, from the United States, and from China. So that will be very interesting.
That sounds fantastic. Definitely be there to attend that. Bert, thank you so much for your time and insights.
It's been a pleasure. Thank you for having me.
Pleasure is all mine. Kopi Time was produced by Ken Delbridge at Splice Studios. Violet Lee and Daisy Sharma provided additional assistance. All 100 episodes of the podcast are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Group Research Library. Have a great day.